Today we're going to look at different ways to value inventory. There's 3 different ways we're going to look at, and they are all in conformity with generally accepted accounting principles. So there's some different methods you can choose from. A lot of companies, of course, merchandising companies and manufacturing companies will have a lot of inventory. But then there's also companies that you might not think about that carry inventory that may be a partial service company, such as auto repair or home repairs may have inventory as well. Anyway, the first one we're going to look at, if you look at your handout, these are actually defined on here, and since they're so easily confused, it's a good idea to kind of review over it. But the first one we're going to look at is the first in, first out method, and it's also abbreviated FIFO. And it assumes that the first inventory purchased is the first inventory sold, and the ending inventory is made up of the newest purchases. Then the next one we're going to look at is the last in, first out, and that method assumes that the last inventory purchased is the first inventory sold, and the ending inventory is made up of the oldest purchases. And the last one we'll look at is the average cost method, and using the average cost method is just an average of what all our inventory cost during a period. Now, in using all these 3 methods, you would come up with the same number if prices didn't change. But we all know that prices change over the period generally, and a lot of times they're going up. Now, the methods we'll look at today, you may be using a periodic inventory system or a perpetual inventory system. I'm going to show you how to do this if you were using the periodic inventory system. Using the periodic inventory system, we only take inventory periodically and do not keep up with it perpetually. Why am I showing you this? It's a little bit easier to grasp and do the problems using the periodic inventory. There are a lot of calculations to this. Especially, we're just going to look at valuing one inventory item, and in your business you might have lots and lots of inventory. So most companies have computers to do their inventory, but we're going to do it all by hand today. As I mentioned, let's look at the problem that is on your handout. It gives us the same information that's up here. We started the year with 600 units of this particular item, and we paid $4 each. That was our beginning inventory in January, and we're assuming a calendar year company. Fiscal year is their calendar year. On April the 1st, they purchased 800 at $5 each. On August the 5th, they purchased 200 at $9 each. And then when we came down to November the 7th, 400 at $11 each. So when it comes time to, and it tells us also in this problem that there are 700 units left on December 31. So what cost are we going to use for these 700 units? Are we going to use the $11 each? Are we going to use the $9? Are we going to use the $5, the $4? Again, it depends on the method that you choose. If we're using the first in, first out method, we assume that this method assumes that, again, the first ones that we purchased are the first ones that are sold. So when we go to value our ending inventory, these units have been sold up here. So we actually start at the bottom. We call these layers. We're going to start at the very bottom layer to come up with the cost for these 700 units. Okay, here it says our last 400 units we bought were $11 each. So I'm going to go ahead and put that 400 over here under FIFO, which stands for first in, first out. 400 at $11, and I think that gives us 4,400 if you multiply it out. But what else do we have here? We had actually 700 units left. So 400 of these units we would have had left, plus it looks like we have some back from our purchase on August the 5th. We purchased 200 there at $9 each, so we'll go ahead and put the 200 at $9. And that will give us 1,800. So if we add those two together, we get 600, the 400 plus the 200, but we're trying to cost a total of 700. So we must have had some way back in this layer on April the 1st that we still haven't sold. And back on April the 1st, we bought 800 at $5 each. but we only need to cost another 100. So we only have 100 of the units that we bought on April the 1st. So we'll go ahead and put that 100 down here. And what was the cost for that 100? It was $5. Okay, so multiplying that out, we would get $500. And if we add it down, 4,400 plus 1,800 plus 500, it comes down to 6,700 as the value for our inventory of that one particular item. What I want you to understand about this when we're comparing these methods is this may not have anything to do with the order that we actually sold our inventory in. It's just a cost, the way the costs flow, and all of them are acceptable. You can choose between them. This next one is LIFO, or last in, first out. Last in, first out is exactly the opposite. We assume that these last ones we purchased are the first ones out when we sell, so we're going to start at the top to value our inventory. Again, we're trying to value a total of 700 units. You need to remember, always look at how many units you're trying to cost. Well, our oldest 600 cost us $4. So we have 600 at 4. And if we multiply that out, that gives us 2,400. Now remember, we're trying to cost 700, but we have the cost here for 600. So we need to come down to another layer to get the next, the remaining 100 units. So 100 of these 800 units are would still be there. And they are at $5 each, which gives us, multiplying out, 500. What you need to do when you're working on this is you always need to total down and make sure you've really costed 700 units. Same way over here. Make sure that these really come down to 700. You know, people often get confused with the layers and exactly how many they need to cost, so always make sure that your total comes back to the number that you're trying to cost. Okay, and if we add the cost down here, we get 2,900. So you can see when we compare and contrast the first in, first out with the last in, first out, if the prices are rising like they are here, we get a very different number. This one's 6,700 and this one's 2,900, but there was quite a variation in the price. Now the average cost is just exactly what it says. I find most people know what an average is. Average is nothing more than the total costs over the total units, and then that gives us an average cost per unit. Okay, so if we're going to do that with this particular group, all we need to do is we have to multiply everything out to find out what our total costs were. All right, so if we take 600 times 4, we should get 2,400. Going down to the next line, 800 at 5, we get 4,000. 200 at 9, we're going to get 1,800. And 400 at 11 gives us 4,400. Then we want to total and get what the total costs were. We have to add them all the way down. And if you've done that right, you should have 12,600 when you add that down. Then you also want to add down your total units. What was the total number of units that I bought during the period? And that's going to come down to 2,000. We add the 800, 600 plus the 800 plus the 200 plus the 400. All right, so when coming down to calculate the average cost per unit, we take the 12,600 from up here, divide it by the 2,000 from over here, 2,000 units, and if we divide that out, average cost per unit should be 6.3. Then We want to multiply that per unit cost times the number of units that was left, which is 700. And that gives us a total, should give us a total of 4,410. So the average cost method was pretty straightforward. A lot of times people get FIFO and LIFO backwards and get mixed up in the layers. Hopefully you won't do that. But with the average cost, it's pretty simple because you're just getting the total cost. It takes longer to calculate, but most of us understand what average means, just an average of the total cost that we purchase our inventory at for the period. But as you can see, if you look at the bottom here, when prices are changing, whether they're going up or going down, LIFO and FIFO are going to give us different answers, and average cost will always be in between. So if you're comparing three methods, you'll find that the average cost, if you calculate it correctly, will be in between your FIFO and your LIFO costs. But as we talked about here, these prices were going up. So there's a big difference between LIFO and FIFO. Keep in mind that this is just for one inventory item. If we had a business, imagine if we had 10,000 inventory items and we were calculating and comparing what kind of difference that would make in the cost. Let's talk about how this would impact our financial statements. Inventory is a current asset until it's sold. What happens when it's sold? It's out the door, it's gone, right? But once it's sold, it becomes part of the cost of the sale. So it becomes an expense. And what happens with expenses? They're deducted on our financial statements to give us net income. Net income, again, being our bottom line. So the inventory method that you choose, even all these are perfectly legitimate, can definitely affect your net income. And when we're having when prices are rising, the inventory method that gives us the highest inventory when prices are rising is the first in, first out. And FIFO will result in lowering our expenses because we're keeping more of our cost of our inventory in assets. We'll have lower expenses, and it will give us a higher net income. So the higher the dollar value of income, the higher our net income will be. And there's a couple different ways you can look at that. There's a lot of companies in the past that have wanted to make their books really look better than they did. And when their auditors came, they tried to find inventory that really shouldn't be there to add it to their inventory so their net income would look better. On the other hand, there's actually a rule, income tax rule, that whatever method you choose for your financial statements to value your inventory, you also have to use it for your income taxes. So LIFO obviously is going to give us the lowest net income, so those places that would be trying to minimize their taxes would want to choose LIFO, or might be tempted to choose the LIFO method. Something that's very interesting about this is right now we're in the process, the United States is, with trying to converge with international accounting standards. And this is being debated right now because we're the only country that still uses LIFO. And there's been a lot of places a lot of companies that are very against doing away with LIFO method. Because if they do, they'll have to go back and use it on their income taxes. You can change inventory methods, especially if there's a law change, but they'll have to show the difference, the gain, if they change their method, the gain in their income, and would have to pay income taxes. So it's a very controversial topic right now.